Hi guys, welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about how to invest during the market crash. So make sure to watch the full video. Is the stock market crashing? Stock market crashes are only clearly identifiable in hindsight, but many investors have worried about a crash in 2022. Throughout the year, the markets have been experiencing extreme volatility over concerns about rising inflation, interest rates, and global geopolitical uncertainty. While investors found some relief midsummer, by the end of August, worries of a sustained downturn resumed, as the S&P 500 and Dow both fell more than 4%. Higher than expected inflation numbers and fears of sharp interest rate increases to curtail inflation caused another downturn September 13. The Dow fell more than 3.5% that day, the S&P 500 fell more than 4%, and the tech-heavy Nasdaq 100 index fell more than 5.5%. Markets continued to drift downward for several more days. Although history can tell us how long crashes, stock market corrections and bear markets typically last, no one gets a calendar notice announcing the time, nature, and projected magnitude of future dips. What is a stock market crash? While there's no specific number that indicates a crash, here's a bit of context. The S&P 500 stock index typically changes between 1% and 1% on any given day. Anything outside these parameters could be considered an active day on the stock market for better or for worse. If the S&P 500 drops 7% in a single day, trading may be halted for 15 minutes. This has only happened a handful of times in the market's history, and indeed marks a very bad day on Wall Street. A crash is marked by a sharp and sudden drop in stock prices, usually following an uptrend in the stock market, also known as a bull market. Stock market crashes in history. Even though the stock market has its roller coaster moments, the reality is that stock market crashes aren't that common. A few of the major U.S. stock market crashes of the past 100 years include 1929. The stock market plunged in response to a contracting economy and investor panic, marking the onset of the Great Depression. The market bottomed out in 1932, more than 80% below peak prices, and took over 2 decades to recover. 1987. The market plunged 25% in response to market decline, investor panic, and early computerized trading gone awry, on a day known as Black Monday. However, the market recovered within 2 years, and the Securities and Exchange Commission implemented trading curbs and circuit breakers to prevent panic sell-offs. 2000. Following a surge of investing and speculation in internet-related ventures during the 1990s, the dot-com bubble burst in March 2000. The S&P 500 dropped nearly 50% and took 7 years to recover. 2008. In response to the housing bubble and subprime mortgage crisis, the S&P 500 lost nearly half its value and took 2 years to recover. 2020. As COVID-19 spread globally, in February 2020, the market fell by over 30% in a little over a month. But by August 2020, the market had already rebounded, taking 6 months to recover. 1. Know what you own and why. A fear-driven reaction to a temporary slump isn't a good reason to dump an investment. But if you look back at your original stock research notes, you may find some good reasons to sell. Thorough stock research includes a written record of the strengths, weaknesses, and purpose of every investment in your portfolio, as well as things that would earn each investment a place in the outbox. Your research is like an investing roadmap, a tangible reminder of the things that make a stock worth holding. During a market downturn, this document can prevent you from tossing a perfectly good long-term investment from your portfolio just because it had a bad day. On the flip side, it also provides clear-headed reasons to part ways with a stock. Ideally, before diving into stocks, you gauge your risk tolerance or how much volatility you're willing to stomach in exchange for higher potential returns. Investing in the stock market is inherently risky, but what makes for winning long-term returns is the ability to ride out the unpleasantness and remain invested for the eventual recovery, which, historically speaking, is always on the horizon. If you skip this step, and are only now wondering how aligned your investments are to your temperament, that's oak. Measuring your actual reactions during market agito will provide valuable data for the future. Just keep in mind that your answers may be biased based on the market's most recent activity. 2. Trust and diversification. When a market decline hits, your results may vary and perhaps for the better if you've invested money across different baskets of asset classes like stocks and bonds. Diversifying or distributing your money across investments is key to reducing investment risk and smoothing the ride through a tumultuous market. Diversifying helps ensure your investments, eggs, aren't concentrated in one type of asset basket. So if one stock or industry has a bad day, your other investments may help offset those losses. If you've gone with a set-it-and-forget-it strategy like investing in a target-date retirement fund, as many 401 plans allow you to do, or using a robo-advisor, diversification already is built in. In this case, it's best to sit tight and trust that your portfolio is ready to ride out the storm. You'll still experience some painful short-term jolts, but this will help you avoid losses from which your portfolio can't recover. 3. Be ready to buy the dip. Market dips can also be a buying opportunity. Think of it as buying stocks on sale when the market crashes. The trick is to be ready for the fall and willing to commit some cash to snap up investments whose prices are dropping. Here's how to tell if you might be ready to buy the dip. You already have an emergency fund. You've allocated money for retirement, and you have cash available for everyday expenses. You've set aside some cash so you're ready for a flash sale when disaster strikes, and you keep a running wish list of individual stocks you would like to own. If you do buy the dip, you probably won't catch the stock at its low, but that's fine. The point is to be opportunistic on investments you think have good long-term potential. Don't be surprised if you freeze in place during the moment of opportunity. One strategy to overcome the fear of bad timing is to dollar cost average your way into the investment. Dollar cost averaging smooths out your purchase price over time and puts your money to work when other investors are huddled on the sidelines or headed for the exits. 4. Get a second opinion. Being an investor is rewarding when the stock market's on a tear and your portfolio is going up in value. But when times get tough, self-doubt and ill-advised tactics can take root. Even the most confident saver investor can fall victim to harmful short-term thinking. Don't let self-doubt sabotage your financial plans. Consider hiring a financial advisor to kick the tires on your portfolio and provide an independent perspective on your financial plan. In fact, it's not uncommon for financial planners to have their own financial planner on their personal payroll for the same reason. An added bonus is knowing there's someone to call to talk you through the tough times. 5. Focus on the long term. When the stock market declines, it can be difficult to watch your portfolio's value shrink and do nothing about it. It can be especially hard to watch your portfolio shrink in a year when you might have gotten sick, grieved, or lost or changed jobs due to the COVID-19 pandemic. It's normal to feel pessimistic after a crash, but if you're investing for the long term, doing nothing is often the best course. It's important to remember that when you sell investments in a downturn, you lock in your losses. Take the February 2020 COVID-related market crash. Say you had $1,000 invested in an exchange-traded fund, or ETF, that tracked the S&P 500. Such a fund would have lost more than 30% of its value during the spring 2020 crash. If you'd had sold, you would have locked in that 30% loss. But if you'd held on to it, you would have recovered your losses by August and watched it grow since. If you plan to re-enter the market at a sunnier time, you'll almost certainly pay more for the privilege and sacrifice part, if not all, of the gains from the rebound. 6. Take advantage where you can. Watching your carefully curated portfolio take some unpleasant dips can be painful, but making moves for future, you could help offset some of that discomfort. Financial planners often point out that market declines can be good timing for Roth conversions. Investors can take stock of the depreciated assets in their traditional IRA and transfer some of that money into a Roth IRA. Once the market begins to recover, you can happily watch those migrated assets grow tax-free. It's important to note that Roth conversions may not make sense for everyone, though. One concern is that they often trigger additional taxes since the transfer creates ordinary income. Talking with a tax professional can help clarify if the move makes sense for you. Buy more stocks if you can. There is a perfect opportunity to buy more stocks when the market crashes. If you have saved enough and have other assets that generate income for you, this is the right time to buy more stocks. The reason for this is simple. A stock market crash signifies all the prices are down, and this is the perfect opportunity to buy low and sell high. We all know the thumb rule of the stock market: buy low and sell high. In the case of a stock market crash, you can buy more short-term and long-term stocks that will book profits when the market is up again. But are you going to buy the stocks blindly because they are at a low price? I bet that would be a mistake. We get it. The stock market crash is luring investors who want to buy more, but that does not mean you can buy stock blindly. Here, as a stock marketer, one needs to have patience and solid research of the company. This research includes important data, such as the estimation of how long it will take the companies to raise the stock, prices by giving a great performance if the expense ratio and other statistical data point the investors in the right direction, and if the stock market crash has, directly and indirectly, impacted the company in a way that can disturb the performance of the companies. After all of the above is taken into consideration, one can invest and book more profit after the stock market crash. However, all of this hard research needs to be done in minimum time before the stock market crash impact is reduced and the prices rise again. Get more long-term investments. This is a perfect opportunity to invest in long-term stocks is right when the market has hit the rock bottom. The reason for this is simple: long-term stocks that last for over 10 to 25 years yield more profit because of the indirect impact of deflation and high profit margins. You must be wondering how deflation can be one of the reasons for higher profits. The reason is what you invest today will hold lesser value in the coming 100 and 1,215 years because of the deflation, and that time, the investment may be considered minimal, but the profits will be much more in number. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.